When Pfizer's stock price declined during the stock market crash in the year 2000, it provided another example where analysis can still be done even after price has been adjusted several times from multiple splits. This is shaping up to be a situation where a minor, neutral to bullish phase will not proceed to fill in a gap down. Bearish volume returns with increasing strength after a normal downswing resisted price back under the gap down level. The last 3 days demonstrate a case of rapid dynamic short-term developments drastically altering the broader context. Now a gap fill is much more likely. No bearish continuation was conclusively declared in early December, since the bull hammer prevented a row of more decisive closes under 2071, which marks the initial absolute low of the wider gap down range. Interestingly, the gap down range is a declined double bottom variant with flatter price action. This now becomes an approximate gap up fill range. Like many other examples before, here is a situation where gap up levels and ranges reverse rolls as new gaps form. It is similar to how regular roll reversal has old resistance provide support to falling price. In the short to medium term, the uptrend develops a more aggressive phase. In the new year, as the gap up is not immediately filled. The fill does begin, but there is external influence from residual support at 23.21. The larger bullish recovery in development forms the broad 20 to 25 range that is validated by lining up with clear long-term swing points in the past. This is just the same as validated support and resistance levels on a chart that hasn't had price adjusted from splits. Towards the next broader market decline that was the 2008 to 2009 recession, the uptrend line and lower 20s still offered support, with smaller upswings to slow down the eventual bearish acceleration. The long-term descending trend line is quite precise in marking the approximate area where price crosses back above it to mark the phase where a long-term recovery begins to finally establish. It even presents a less common situation where a large downtrend line reverses rolls to intersect with a precise level for stronger support potential. This is done in late 2011 at the approximate intersection with the 1750 level. As clear resistance emerges around the mid-30s, there is an inclined double top range that is quite valid with price action neatly contained within its outline. Theoretically, a small double top produces a small drop, and an inclined variation has more residual bullish sentiment compared to a flat or declined double top. This is true most of the time, but here is an exceptional case. Approaching July 2016, there was an overly steep bullish incline that lacked high bullish volume and regular bearish retracements. Since these features weren't present like they were in May and April, the uptrend was becoming less sustainable and a large correction was more likely. Like normal, the uptrend lines and 30 to 29 range offer natural support in gradually halting the drop. Interestingly, this area is derived from an inclined double bottom that has a wider upper boundary shared with an ascending triangle. That is why there is a much greater bullish acceleration to jumpstart the rapid uptrend in April. Price action in the highlighted pattern areas is quite clean, since it is neatly contained within the three outlines. A gap up is just barely filled, as an upswing's absolute low makes brief contact with the 30-50 level, it adds additional context with the later completion of a double bottom range that is weak to begin. A bearish star on December 14th leads to bearish and increasingly neutral activity prior to the normal period of low activity into the last week of the year. A larger uptrend line benefits greatly from the foundation of the double bottom and gap fill combination. This is helpful as persisting selling pressure into the new year has a reduced impact due to major supporting influence from the stable uptrend line. Price action is neatly contained in a larger ascending triangle outline with several periods of 3 methods rising price action. Once again, solid bullish continuation price action has a lesser impact due to proportionally higher bearish volume that remains due in large part to rapid drops of the past few years. Though towards the end of 2017, the uptrend gains a solid foundation from gradual increases in bullish volume and price action. The resulting uptrend line from so many upswing points on a shallower incline leads to solid support that is only breached by bearish spikes following a gap down. Further validation of the highly influential trend line appears when several bullish spikes are swiftly repelled by it on the same general trajectory. Interestingly, the solid trend line also marks the precise area where a compact double top continues the larger downtrend, upon breaking its lower boundary at 39.83. Which happens to be the opening price of the past gap down. A look back reveals more validation of recently identified price levels lining up with much older swing points. This even includes periods before, during, and after some stock splits. This Pfizer stock chart reiterates that price is adjusted after stock splits, but the general outline of price action does not change drastically. Here there is also the clear contrast of shallower trend lines, generally lasting longer than steep trend lines.